Hello and welcome to this interview brought to you by Livewire Markets. My name's James Marley, I'm a co-founder at Livewire, and today I'm joined by Tom Richardson. Tom's portfolio manager at the well-renowned and well-respected Paradice Investment Management. Tom, great to catch up. Good to have you in the hot seat.
Thank you, James.
We're going to be talking a bit about the investment market backdrop from an emotion perspective. We're going to be talking about some things with regards to yields and where they're headed and why that's something that Tom thinks you should be keeping an eye on. We'll talk about how he's thinking about finding opportunities and the process that he uses to uncover equities that are cheaper than the market. And then we're going to get into materials, which is a part of the market that Tom knows particularly well, and talk about a few of the ideas that he's got in that space. So Tom, let's get into it.
Excellent.
You look for opportunities where emotions of investors get too skewed from one end to the other. We know people get excited and they can get too bearish. It's a good time to be talking about emotions because people are on edge at the moment. Can I get you to explain the concept in a bit more detail and perhaps use an example of how you use short-term thinking as an opportunity?
Absolutely. Well, it may not be a surprise that as an active manager, we have a belief that markets are inefficient. And a lot of those inefficiencies come down to short-term thinking or emotional investors, and where they extrapolate the current environment for too long and don't take a step back. And I think over the last 2 years, it's safe to say that we've seen that in spades. Now, I've actually got a chart here that your viewers at home can look at. And what it is it's the consumer goods spending by the US consumer. So the categories within here are sort of home furnishing, electronics, car accessories. Basically think anything that turned up in a cardboard box at your front doorstep, James, over the last 2 years. That is what is in this bucket.
Shoes, designer shoes.
Shoes are in there. Your designer shoes are definitely, I think I can see the uptick there, James. But what it shows is this is a 30-year chart. And the acceleration is absolutely phenomenal. Now, this may not be a surprise to many of your viewers who are very aware of the services to goods shift that saw when we were all sitting at home. But what was more surprising to us, we did this analysis at the start of the year. We looked at all the companies that were exposed to this thematic. Now, the consensus forecast for these companies had no normalisation. So I look at that chart and I don't know where you think it's going, James, but there's a good chance it goes back to that dotted line. There's a good chance it goes under the dotted line because it's almost impossible to forecast what the backside of a demand curve will be when you've had such a pull forward. I mean, you've bought so many designer shoes, James. I'm not sure if you can buy any more.
I've got to get out and wear them now.
But what was remarkable was the consensus forecast just thought this was the new normal. These companies had grown by 50% and they could continue to grow at 10 to 20%. So we're in a bit of a reckoning period as some of these stocks are starting to realise that. But unfortunately, it's not an opportunity sector for us here, James. But it's one that we're very cautious on, and I think it highlights why we think markets can be inefficient. Okay,
so the takeaway from this chart is really that people extrapolate what's been the recent past way into the future, and the reality is, I mean, look at the history of that. It was such an extreme that we experienced that there's a reversion to the mean, and it takes a while for markets to adjust and prices to correct.
Absolutely.
Okay. I think another chart you brought along looks at the impact of rising real yields, and yields and real yields has been something that's been bandied around a lot in the last few years, particularly because we went in a period of time where real yields were negative, which was kind of crazy. I thought the chart was interesting because it paints somewhat of a bleak picture for equity market valuation. So, what does the chart show us, if we can bring it up? And why does it matter for investors, and what are some of the flow-on effects that it has for how you're positioning?
Sure, so it's a great chart. It was put together by Citigroup actually, and so it's a regression model of the US market over the last 50 years. And what you can see is on one axis it's got the forward multiple of the market, and the other it's got the US real yield at that time. And what it shows is that when money is free, the market's expensive, and when there is a cost of capital, markets get cheaper. And we're in that transition period at the moment. In fact, we've had the fastest adjustment in the cost of capital in 30 years. And so this note actually came out on the 29th of April, which actually feels like a lifetime ago, James.
Yeah, it does a bit.
And you can see that I've crossed out the now as it was written. And at that point, the US market was trading on 19 times PE. And the real yield was still negative. It was about 0.2 negative. Now, very quickly, as we were aware, central banks are catching up and they're pushing interest rates much higher. In fact, inflation expectations have actually come back a little bit in the last 6 weeks. But that's meant that the real yield has gone to about 0.7. And all the real yield does is it adjusts the nominal interest rate for an expected rate of inflation. And so, as you can see, since that period, the market's fallen 15%. It's been a very dramatic adjustment. But if you look at the regression over 50 years of data, it's sort of as you would expect. Now, the real yield change has probably happened quicker than we would have expected and likely quicker than many in the market. But in terms of the rating of the market in response to that real yield, it looks pretty fair.
Mm-hmm. So a couple of questions flow off the back of that. First one, how much more of this normalisation or correcting, and I know you don't have a crystal ball, but what are your expectations based on where we are today?
I think the first belief is that we're not going back to negative real rates for a long time. So this is the new norm. So don't expect some miraculous bounce. In terms of whether real interest rates need to be 1% or 0.5 or 0.7 to slow down the cycle and ultimately cool inflation is very hard and not something that I'll get into. But in terms of positioning, the most extreme evidence of this, and so this is really for a market multiple, the most extreme evidence is in terms of growth and duration assets. And their multiples come down the most in response to this. So from a positioning perspective, what it means is we're positioning in more short duration assets where you're getting the cash flow up front. And it would be very cautious, still very cautious on high growth, high PE businesses. Unless you're very, very confident that the growth will be there on a 5 to 10 year view, I think the de-rating continues for that sector.
So Tom, you've painted a somewhat, I don't want to say too bearish, but there's a few headwinds and challenges for investors, but you've got to go out there and find stocks. I understand you've got a 4-factor portfolio construction process. Got to get you to talk through each of the steps that you do to uncover opportunities, and then I'm interested for you to talk about how you find good opportunities that look more attractive in terms of some of their fundamentals, but are actually cheaper than the market.
Absolutely. It's a pretty simple model. We just look at the PE, the growth, the balance sheet, and ultimately the free cash flow yield. So 4 very simple metrics. But what we've found over 15 years is that when our portfolio ticks that box relative to the market, we outperform. But it's also a very constructive formula when you're looking at stock investment. So it takes out the narrative, takes out the story around the stock and looks purely at the numbers and where do we see opportunities based on the numbers and the growth that we can see within the stock. And so when we look through those factors, it's still difficult in the market to find a lot of ideas, but the sector that we're gravitating towards really is the energy sector. So they're looking cheap. The stocks have derated that on the expectation of peak commodity pricing, which we can touch on later. They're growing because obviously the commodity price is growing, but they also have development assets, which is growing production. The balance sheets are de-gearing very quickly as they're spewing off a lot of cash within this environment price. So we're very aware of the cyclical risks that we are taking, but there's a lot of supply changes within that sector which give us comfort that these prices are a little bit more sustainable than they have been in the past. So energy ultimately ticks those boxes for us, and it's the sector that we're overweight.
Okay. Now, one of the other things that stood out when I was doing a bit of background research is that you said you like taking stock-specific risk. Risk's one of those words that people say, I tend to want to avoid that. This is a risk that you want to gravitate towards. What's an example of stock-specific risk and why you like it?
Well, in terms of stock-specific risk, what we're trying to do is here, the macro is very difficult, very hard to predict. So anywhere where we can put in stock-specific risk over just a generic factor risk, that's good for our portfolio. The one caveat to that would be commodity-specific risk. We're absolutely willing to take on commodity-specific risk because we have very detailed supply-demand forecast for all these commodities, and ultimately it's our job to work out whether the commodity is going up or down. So in terms of that, and it's interesting, I mean, you think about these growth names that we touched on earlier. A year ago, it was all about these companies that were changing the world and amazing stories, whereas this year, it almost feels as though they are dependent on inflation falling and interest rates falling for those stocks to work again. So we don't want to tie ourselves to one factor that's exogenous that we can't control. Mm-hmm. So we want to put stock-specific risk into the portfolio where we can. And one of the stocks in our portfolio that we think can work is Qantas. And it's the reason I mention it is because we're very constructive on the energy thematic. As I touched on earlier, we think that oil price is going to go higher, which is a huge headwind for Qantas and the airline industry in itself. Yep. But we still think that Qantas is actually good value. And the reason is that because capacity management ultimately will dictate returns for that industry. And if you think about their domestic position, they are very, very well positioned, especially with Bain being the owner of Virgin now. So they're already managing capacity. And internationally, they're getting steamrolled in terms of demand, and most of the routes are still only at 60% capacity because they can't put it on. And so prices are going high. They have to do that to recover oil. I'm sure you've been on the websites lately, James, and they're pretty high, but they have to do that to recover their costs. And then the last point with Qantas is they have the frequent flyer business, and it's been a bit of a duck underwater because while they've had planes grounded, COVID shutdowns, that business has ticked along really nicely, and they're actually targeting 500 to 600 million of earnings in FY24. Now, the street expectations are well below that. So if they can achieve that, that's going to be 30 to 40% of the group earnings coming from a very capital-light growing business, which ultimately deserves a higher multiple. So despite the fact that we think energy is constructive, we think that the Qantas can work in this environment.
With airlines, how much of the that inflationary pressure can they pass through to the consumer?
Well, we're about to find out. We are about to find out, because I'm sure you've looked at possibly looked at a business class ticket to the US. They're very high. The demand inelasticity that they're seeing at the moment is very small. Now that is because this spend is the complete reverse of that chart that we put up in topic 1. Yeah. The goods, you're spending a lot of you might buy a few less shoes, but you might have to buy a few more tickets. So in the next year or two, we think that demand inelasticity is going to be very low. Yep. So ultimately it's going to be, that's a challenge for the industry to pass through these costs, but ultimately we think that people are willing to do it because people want to get on planes again. Okay.
Now, you've alluded to it a few times. You guys have got some constructive views on materials. There was a comment or a caption on one of your slides that I saw talking about the fact that materials have got high prices and they're going higher. That seemed like almost a consensus view up until recently, where we've seen materials give up some of the strength that they've had. Talk me through your thesis on the materials sector and why you like it.
Well, we think about the prices are high for a lot of commodities at the moment, and everyone's familiar with that. But commodity prices don't go down just by themselves. They'll either go down because supply rises or demand falls. And so if we touch on the first topic, we've actually got a chart here which you can put up, which shows the investment within the basic resources as a percentage of GDP versus the return on those assets. And what understandably happens in a normal cycle is prices go up, investment responds, supply follows, and prices come down. You get a normal cycle. What's really interesting in this cycle is that there's been minimal investment for a decade, absolute underinvestment almost across the board in commodity land. And so you can see that the return on assets are up almost to where they were back in 2007, but there has been no response in terms of supply. Now the reason for that is if you go back to 2012, 13, 14, the amount of capital destruction from the mining companies and the energy companies was obscene, absolutely eye-watering. So everyone's put their wallets back in their pocket for a while and they only get them out to give it to shareholders. So that is why this cycle might last a little bit longer than people expect, is there's just no supply response. And then if you think about demand, now clearly we're going into a slowing demand environment which will have an impact on commodities, and that's what we've seen over the last 5 months. But there's two key elements that are different this time. The energy transition is commodity intensive, almost across the board. It's just incremental for some and large for others. But any way you look at it, the energy transition is going to require more commodities. And the second element is that China is the absolute biggest behemoth. It's 50% of most commodity demand, and they've been in shutdown. I mean, the first half of this year, they have not pulled through as much as they would normally. So if they can fire up that economy in the second half, we could be in for a bit of a surprise here and commodity prices could move higher.
Mm-hmm. Do you spend time thinking about where you could be wrong on your thesis?
Oh, absolutely, all the time. And it's important to say that over the last, you've highlighted that materials have been a great performing sector, and it's basically be it by any commodity and they've worked. As we go into a slowing demand environment, which we absolutely are, it is time to be a little bit more selective in your commodity exposure. And so the two areas that we're focused in terms of our commodity exposure from here is ones where you have a structural demand story, where you really are underwritten on that demand supply, even if we go into a slowing demand environment, or you have a supply story which is so compelling that it's hard to see, even with a slowing demand, getting back to some sort of cost support because the supply is just not going to be there. And ideally we can find commodities that have both of those boxes ticked.
Okay. Materials, it's the second best performing sector behind energy, which you've sort of indicated you've got a strong thesis on energy. But you still think the stocks look cheap, and we're talking about a number of stocks that, if you look across the lithium space, they've come back, they're still up. Some of them triple, have up 100%, mid 50%. But you still think a lot of these materials stocks look cheap. Can you talk me through that in a bit more detail, and maybe we'll get into a few examples in a minute?
Absolutely. Your investors are probably aware of the old adage, which is sell mining companies when they're cheap and buy them when they're expensive.
Just explain that adage to us, because okay. I was thinking about that, and I need it re-explained to me.
Well, as we've seen on that chart, which shows the cycle in terms of return on assets, this is a highly cyclical sector. And so what happens is when these resource companies make a lot of money, their PEs become cheap, and that is in response to high commodity prices. Now, generally, that is the time to sell the sector. And then when they're not making any money, as you can see from this return on assets chart, that is absolutely the time to buy the sector, because inevitably supply will reduce, demand will pick up, and you'll make money again. So generally speaking, you want to be buying these stocks when they've got high PEs and selling when they're low, which is a bit of unusual.
Counterintuitive.
Exactly. But this time we think the stocks are on low multiples, so they are cheap. But we think, for the reasons that I've just articulated, that commodity prices will stay higher for longer than a normal cycle. Dangerous to say that. And then with a slowing demand backdrop, we want to be careful, and so we're watching demand very carefully. And so any commodity that we think has incremental supply, we're getting more cautious on, or any commodity that we think was a bit of a COVID beneficiary and it was a benefit of stimulus that is coming out, we're being cautious on. So we're definitely being more selective on our commodity exposures this year versus last year.
Well, let's get into a couple of specifics. I've asked you to rank 3 commodities that you think have the most interesting outlook, and pick a high conviction idea in each of those commodities, and start from 3 to 1. Give us a bit of a countdown.
Okay, sounds good. Well, we'll kick it off with number 3, and it's rare earths, and more specifically NdPr, which is a key ingredient for high strength magnets. Now, this is a key ingredient for electric vehicles and wind turbines. It's really enabling the energy transition. So demand growth is probably looking at 20%, 15 to 20% for the next 3 to 5 years for our calculation. And so it ticks the box that I touched on earlier around structural demand stories. Now, it also ticks the box of no real supply. So China controls 60% of the resource, they control 90% of the process, and everyone has just woken up to the fact that this is probably a little bit of supply risk, and we need to get our supply chains outside of China where we can. And that's ultimately led to the Australian government looking to fund a refinery here in Australia from Iluka, and the US government doing similarly with Lynas. And so the other thing is that the commodity price has gone up, let's say 3 times. The commodity price is about, $120 now. It used to be sitting at 40, so it's definitely had a good run. Let's not consider ourselves. But in terms of the next wave of projects, they need 120 to get up. In fact, they're not getting up. There's probably 5 or 6 rare earth companies in our market with very small market caps, struggling to get funding, struggling to get up. So the commodity price signals are not quite there. So it's very highly likely, or possible in our estimation, that the commodity price will move higher to ultimately bring those commodities
to incentivise
that supply. Yeah. And so ultimately, Lynas, we think, is very well positioned, obviously, with the plant here, and they're building in Australia and their position in Malaysia. Number 2 is the...
That was pretty good.
Oh, sorry,
I like where we're going. If that was number 3.
Okay, yeah, good. Number 2 is the fertiliser market. Yeah. And again, we're looking for supply and demand balances that look really strong. And specifically with fertilisers, we're looking at the phosphate market. So the phosphate market, again, has had no investment in it for a decade. There was oversupply going back, and prices were in the doldrums only up until 3 years ago. The Russia invasion of Ukraine has made that situation very interesting. Ultimately, it's impacting gas markets, but ammonia impact, and then also the cost pressure on phosphate producers is rising significantly as well. So there's not a lot of spare phosphate production around. And then if you think about the demand, obviously you're underwritten from a soft commodity perspective, which is very high, but incrementally, phosphate is going into LFP batteries. So that is a lithium iron phosphate battery. So when you have electric vehicles, you basically have 2 different types of batteries, and LFP is one of them. So it's only a small amount of phosphate goes into the battery, very small. But when you're talking millions and millions of vehicles, it's starting to add up, to the point where the latest numbers, and this is only very recent, they're starting to work out, China exports about 8 million tonnes of phosphates each year. And the market, the rest of the world is reliant upon that material. Now, they are pivoting that production to electric vehicles, obviously, rather than exporting phosphates. Why don't we put it into electric vehicles with higher manufacturing? And the estimation is probably 2 to 3 million tonnes will come out over the next 2 to 3 years of that. And so at a time when demand is growing, there is no supply, it's very hard to see the phosphate market going down. And so Incitec Pivot is a big, broad business, but they do have one phosphate plant up in Queensland, Phosphate Hill. It's under maintenance at the moment, so touch wood, it starts up okay, but they're very well positioned to make a lot of money out of that plant for the next 3 to 5 years in our view.
Interesting. And is phosphate a hard thing to find? Is it a hard commodity to locate?
Well, it's about phosphate rock, and that's why Incitec's very well positioned, because they have the rock. There's also non-integrated producers who have to buy the rock, and the rock price has gone up a lot as well. So it's not just about the phosphate rock, it's about the gas and the sulphur as well. So you've sort of got to have a bit of the triple threat, and they're very lucky with their position in the moment. Okay,
so that's number 2. Number 1, what's your top of the pops on the commodities?
Do you want a drum roll? No. Well, I might have given it away. It's natural gas, LNG markets. I mean, they are just a huge there's such a huge supply challenge within this market for the next 5 years, in our opinion. And it all stems back to what we talked about, 2012 to 2014, the LNG investment. We've seen it in Australia probably more than anywhere. The amount of money that was torched, there's been no investment. No one's looked for it. No one's built anything for the last 6 years. And so there's been no supply growth. And now ultimately what's happened with the Russia invasion of Ukraine has meant that Europe is incredibly short gas. Everyone is familiar with that. And the supply challenges is enormous. In the backdrop, you've also got ex-China Asia growing. And so the LNG market still probably needs another 70 million tonnes over the next 4 years. And there is just no projects ready. And so Woodside, with the merger of the BHP petroleum assets, is incredibly well placed. They've got uncontracted molecules in very low risk jurisdictions. It is absolutely what the world needs for the energy transition, which is obviously taking longer than we may have expected a few years ago. So Woodside and LNG looks like a very good place to be parking some money for the next 3 to 5 years in our view. Okay.
Alrighty, great pitch. Well, Tom, thanks very much for coming in today. I really appreciate you bringing along these charts. Hopefully for you viewers, you've learned something new. You've got Tom's top 3 materials sectors and the stocks that he's using to play it. So Tom, thanks very much for coming in. For all you viewers, remember, hit subscribe on the YouTube channel. We're bringing you fresh content every week. And if you enjoyed this wire, why not give it a like?